I'm going to be talking about the US equity market, which we know comprises 65% of the global market cap, and then finishing off with a couple of analyst opinions, which I gleaned from the Financial Times and also from JP Morgan Cazenove. So to start off with the global economy, and this is research from MRB, which is one of the independent research houses that we subscribe to and have done for several years. And they look at the three stools of the global economy, being the US, the Euro area, and China. And those economies combined account for over half of global GDP. And they are critical originators of final demand. So when they're all firming together in a synchronized manner, then it creates conditions for a broad-based and self-reinforcing global expansion. And that is exactly what's happening at the moment. So the global economy has underlying resilience supported by easy monetary and fiscal policies. The lagged response of policy stimulus is now kicking in and boosting global economic activity. And then, of course, we've got fiscal stimulus as well, not just monetary, but also fiscal, particularly in the US and Germany, and also to a large extent in Japan. So if we look at the different regions, the US, the Euro area, and China, in the US, corporate profitability has remained solid, and recent hard economic data point to re-acceleration in economic activity. In the Euro area, monetary conditions are very accommodative at a point in time when German authorities are providing significant fiscal stimulus. And in China, leading indicators point to a modest acceleration in the Chinese economy based on improving manufacturing activity and also service sector activity. And then global trade is very strong. Solid final demand growth in the three largest global economies has led to a boost in global import demand despite increased US tariffs. And that reinforces economic and earnings growth in many smaller developed markets and emerging markets, export-oriented economies. The global PMI manufacturing surveys are strong and predominantly above the boom-bust line, which suggests, looking forwards, that there will be continued growth in that sector. So brisk and broad-based global expansion reinforced by easy monetary and fiscal policies is generally positive for risk-taking. Already, corporate profit margins are wide and earnings growth is solid in most countries. Now, the offset to that is that most equity markets are no longer cheap and earnings expectations are elevated. The economic and investment cycle have both matured. And the macro environment is not without risks. The most immediate risk, of course, is an escalation in the energy crisis and/or bond investors being wrong-footed on inflation, which may cause bond yields to spike higher. On the first of those risks, strategic oil reserves are dwindling. And then another risk is that core CPI inflation has bottomed out well above its pre-pandemic run rate in the US and in aggregate across the developed world. Strong global growth and a lack of economic slack is now encouraging a broad-based firming in inflation. G7 bond yields have lifted lately and could reach levels later this year that become disruptive for global equity markets. A move in the benchmark 10-year US Treasury yield towards 5% would trigger a risk-off pivot amongst investors. I'm turning now to a very interesting report from Bank Credit Analyst, one of the oldest independent economic research houses. And this is on the US economy. Income tax cuts and abundant oil and gas reserves have helped shelter the US economy from the conflict in the Middle East. Long-run inflation expectations have remained well anchored despite the backup in 10 and 30-year Treasury yields. And then, of course, we've got the very high-profile SpaceX listing in the next 10 days. And then after that, the listing of Anthropic and OpenAI. So these splashy IPOs will initially boost animal spirits, enabling the equity market to absorb new supply without any harm to the markets. But where is the capital going to come from? SpaceX is seeking $75 billion. So according to Bank Credit Analyst, the supply overhang will only manifest itself later on when other shareholders are permitted to sell their stakes. And that won't be for a good 6 to 9 months after the initial listing. So let's have a look at the numbers there. If SpaceX raises $75 billion at a valuation of between 1.75 to 2 trillion, that will only amount to 4% of the shares in the company. At some point, the holders of the remaining 96% may decide that they would like to monetize their stakes as well. So when that happens, we may indeed see some trouble in the markets, but that won't happen for about 6 to 9 months after the initial listings. So that could be enough to keep the markets buoyant for at least 6 months or so after the listing period. Let's look at the earnings report, which really were blockbuster. Over 95% of the S&P 500 companies have reported their first quarter earnings, astonishingly reporting an eye-popping 28% year-on-year increase in earnings. But there is a slight caveat. There were one-time benefits to the earnings of Alphabet, Amazon, and Meta relating to the markup in the value of their investments. Excluding the impact of those items, however, year-on-year earnings growth was still 16%, which is really quite phenomenal. Revenues were also strong. In Q1, revenues increased by 11%, compared with a growth of 9% in the previous quarter and 5% in Q1 2025. Robust revenue expansion has kept profit margins resilient. The overall profit margin of the S&P 500 improved to a record high in the first quarter. The technology sector produced the best earnings growth at 53% year-on-year, led by the semiconductor and semi-equipment subgroup, whose earnings doubled year-on-year. The communication services sector reported the second best earnings growth at 51%. Earnings growth is expected to remain very strong in the coming quarters. S&P 500 earnings are projected to grow by 20% plus year-on-year in each of the next 3 quarters, and that's obviously taking into account the markup in the investments of those Mag 7 stocks. Elevated earnings expectations will remain a source of potential volatility, however, for the US equity market. And this is quite important. Companies that missed earnings in the first quarter saw their share prices punished more severely than the historical average, while the rewards for those that exceeded forecasts were mostly muted. The asymmetric reactions underscore that the equity market is already priced for near perfection, and stock prices are vulnerable to meaningful downside risks if earnings fail to live up to lofty expectations. For example, the five-figure fantasy for the index could become reality if demand for AI remains strong and forward 12-month EPS continue to grow at an annualized rate of almost 14% between now and the end of next year. Yet, if things went awry, forward 12-month EPS could end up a lot lower than $435. And given how much they've fueled gains in the S&P 500 in recent years, and given how much is already expected, this could drag the index down significantly. We wouldn't be surprised if the index fell by 30% from its peak if the AI stock market boom turned to bust. So this is our job. It's not an easy job. You're doomed if you're not in the market and it keeps rising, and you're doomed if you are in the market and it drops 30%. So our job is to manage risk, and that is what we do and what we have been doing very effectively over the last 25 years. Risks to look at, of course, the Federal Reserve may begin lifting interest rates, and that is not good for the markets. And of course, as well, the Strait of Hormuz could lead to a much higher oil price unless that situation is resolved. At the current pace of drawdown, the commercial oil stocks could reach critically low levels by the end of June, unless the Strait of Hormuz is opened. It's likely that in a more adverse scenario, inflation would rise to something like 6 or 7% in the UK and the Eurozone, and both the ECB and the Bank of England would raise interest rates perhaps by around 100 basis points. With US inflation also likely to rise towards 5%, the Federal Reserve may also be forced to tighten. In the absence of a deal to reopen the strait within the next few weeks, we are likely to shift our forecasts towards something close to the adverse scenario. And then I'm going to move on to bond yields. Of course, we know very well that if bond yields riot, then that would be a trigger for a big sell-off in equity markets. And there is a major monetary backdrop, according to Alpine Macro, that is largely being ignored. All G7 central banks have actively and in some cases aggressively reduced their balance sheets. So instead of quantitative easing, it's effectively quantitative tightening. The Fed's balance sheet has shrunk by 25% since 2022, the Bank of England's by 23%, and the ECB's by 30%, while the Bank of Japan has shrunk its balance sheet by 14% since 2024. This sustained rundown in central bank balance sheets represents a major regime change for most G7 bond markets. The potential problem is that some G7 governments have already become used to or even addicted to large fiscal deficits. Take the UK and the US as examples. Both governments continue to run large budget deficits at 5% of GDP in the US and 4% in the UK, while public debt to GDP ratios continue to climb, reaching above 120% in the US and over 100% in the UK. Absent central bank QE programs, these sustained large deficits could invite trouble for bonds, particularly if the underlying economy weakens. And now moving on to a few opinions that I gleaned from the Financial Times. This is Mike Wilson, Chief US Equity Strategist at Morgan Stanley. He says, quoting, "There will be frothiness and then correction, but the market can keep marching forward And then Ben Snyder, the chief US equity strategist at Goldman Sachs, he says, quote, conditions that typically mark the end of bull markets, such as speculative mania, contracting profit margins, or Federal Reserve rate increases, are absent. And that fuels my expectations that the recent market rally will continue. And then we've got Denise Chisholm, Director of Quantitative Market Strategy at Fidelity. There's a positive risk-reward trade-off in stocks, mainly around the fact that I think earnings growth is much more durable than people think. I think that's the key to what I would call the secular bull market, because it's the durability of earnings that justifies valuations. And then JP Morgan Cazenove quoting, we believe there is more upside for Mag 7 over the next months as earnings are more than compensating for the rebound in stocks.
Hi, Nick. Thank you for such a comprehensive update. There definitely a lot going on the global side, but I think overall it sounds quite exciting. Welcome to the OM Local Monthly Update for June 2026. And I must say this past month, it feels like there's been a little bit of a theme sitting at the center of the story, which I like to call the squeeze. I'm referring to the tightening of the belt. Inflation data surprised the upside. The Reserve Bank responded as expected, and investors spent most of May recalibrating what a rate hike could mean for our economy. However, I think when you look through the general market noise and into the actual results our portfolio companies have just reported, the picture is far more encouraging than the latest macro headlines might suggest. We'll get there, but first, let me just set the scene by kicking it off with the macro data. Let's start with the number that moved the needle last month, CPI. Consumer inflation for April came in at 4%. That is up sharply from the 3.1% we saw in March. And although mostly expected, it slightly surprised to the upside. And it was almost entirely one story: fuel. Petrol prices rose by more than 15% in the month of April, one of the steepest monthly moves on record. Core inflation, which strips out food and fuel, also rose to 3.6%. The problem is that fuel costs impact almost everything: transport costs, food delivery, logistics, etc. So the Reserve Bank was not really in a position to simply look through this. And they didn't. On the 28th of May, just a couple days ago now, the MPC hiked the repo rate by 25 basis points to 7%, bringing the prime lending rate to 10.5%. However, it wasn't unanimous, with 4 members backing the hike and 2 preferring to hold, which tells you this was a close call rather than a panic move. The SARB is trying to get ahead of second-round inflation effects before they trickle through our economy. Their own forecasts still have inflation averaging at 4.4% for the year, and later pulling back to 3.7% in 2027 before converging towards the 3% target. So in other words, they are not predicting a crisis. However, any potential further rate cuts have been pushed to 2027. Moving to the green mamba currency. The rand was broadly stable through May, trading around 16 Rand 30 to the USD, which is relatively firm given the expectation of a rate hike, some commodity weakness, as well as lingering global uncertainty around oil prices and the Middle East friction. It was likely helped by Moody's revised sovereign credit outlook on South Africa, which changed from stable to positive, citing improving fiscal consolidation and reform momentum. Against the macro backdrop I just described, I think it makes sense that the JSE was pretty choppy in May. Overall though, valuations are not stretched. Earnings from our companies have been broadly solid. Now I think let's turn to the results we received this month from companies in the OAM model portfolios. Starting off with one of my favorites, Pepkor. Pepkor delivered a strong set of interim numbers for 6 months ended March 2026. Revenue grew over 13% and normalized headline earnings per share is up 12.1%. And that's even off of a high base last year. There is a lot going on in this business, so I'm going to stick to a few talking points. The core of the business being retail continues to see real growth, with like-for-like sales growing 5.7% per year over the past 2 years. Ackermans like-for-like sales slowed, However, Pep counteracted that to keep the clothing division going strong. Online sales are also up more than 30%. And we've also seen that the retail credit book is making up more of their sales than in the past, but they're still mostly in the cash business, which we like. What really caught our eye this time though was the financial services division. Operating profit there grew 63% to more than 690 million rand. This division used to be a rounding error. Now it's a business that is scaling rapidly. Oh, and there's also Plus B. Yep, Pepcore's banking license has been approved. We know this is a long game and it will take time to build out, but the strategic direction is clear. Pepcore is now evolving from a pure retailer into a financial services provider for the mass market in South Africa. Now, I haven't even spoken about their informal market, in other words, their flash business. Operating profit there grew more than 23%. Moving on to Raynet. Without going into too much detail, their full year results ending March 2026 can be summarized into the following. Their asset sales were finalized, net asset value declined 4.5%, tons of cash is still left on the books, and a large performance fee was triggered. So after selling its remaining stake in Pension Insurance Corporation, Raynet now holds 83% of its assets in cash and liquid funds. That's representing about 5.5 billion euro just sitting on their balance sheet, waiting to be redeployed. We see this as optionality. Performance fee of 117 million euro was triggered, which is a cost shareholders may not welcome with open arms. And a dividend was also proposed, but it wasn't necessarily as high as many had hoped. The real question now is, where does all this cash go? Raynet has historically been patient and disciplined, and we expect more of the same. But the next large capital allocation decision will be the main driver of future returns, and will probably also determine what our next decision is with this holding. Afrimat. Afrimat's full year results for the year ending Feb 2026 show that the core of the business is still in excellent health. However, some external factors are still hurting their divisions. Just to give you guys a quick summary, the aggregates business is firing. Construction materials demand is holding up as infrastructure spend continues, and Afrimat's market position there is solid. The problems are concentrated in a couple of specific areas. The first being iron ore, which is being squeezed by weak domestic steel sector conditions as well as logistics constraints. This isn't unique to Afrimat, but it's still a drag nonetheless. Anthracite suffered from ferrochrome smelter shutdowns last year, which cut off a key demand source. But we're hoping to see this rebound after the recent NERSA approval of low electricity tariffs for ferrochrome smelters. The company is also carrying a bit more debt than they'd like, with debt equity currently at 50%, whereas their target is 25%. And then there's cement, where the business is still absorbing losses. However, those losses are significantly less than last year, thanks to the improvements their team has made with the Lafarge turnaround. Management is, and I quote, actively exploring strategic alternatives for the cement segment, which sounds like they're looking for a buyer, or at the very least, a partner. If they do find a buyer for the cement business, they could take out two birds with one stone here, decrease their debt, and possibly unlock value. We believe the market would reward them if something like this took place. Overall, the underlying divisions are strong in this business. The management team has earned the benefit of the doubt, and we view their current situation as a transitional recovery phase, not a structural problem. The investment case remains well intact. And lastly, WeBuyCars. WeBuyCars delivered interim results for 6 months ended March 26 that on the surface looks like somebody might have tugged on the handbrake a little. However, looking under the hood, there's a slightly different story. Revenue is up almost 8%, but profits fell slightly. Now that makes more sense when you remember two things. Firstly, they are expanding, which means they're carrying more costs. And secondly, they've also been operating in a deflationary market. Vehicle prices have been coming down, which compresses the gross profit per unit, even as volumes hold up. They are still buying cars, and more importantly, yes, they are still selling them too. The machine is still humming. It's just earning a slightly thinner margin per transaction for the time being. And the finance and insurance income line was a bright spot as well, which tells you the additional revenue streams are gaining traction in this business. What stands out to us is that WeBuyCars is increasingly becoming a tech and data business rather than simply a car dealer. They are developing their own systems in-house, and we know it's going to pay off in the long run. On the expansion side, they opened 3 new supermarkets during the last quarter, bringing the total supermarket count to 20. And the GoBid acquisition, giving WeBuyCars a 49% stake in that platform, is also an interesting move into the digital auction space. The long-term investment case remains compelling, supported by market share gains, tech-driven advantages, and additional revenue opportunities. We are happy with this holding. So I think it's important that we rewind back to that theme that I opened up with, the squeeze. May 2026 delivered that in full. A fuel-led inflation spike, a Reserve Bank that responded quickly, and a JSE that took a little bit of a step back, as well as 4 sets of company results that each carried their own pressures. But here's what I would like for all of you to take away from the local update this month. Every single one of our portfolio companies has a clear strategic direction. It is managed by people who understand their markets and is operating in an environment that structurally is better than it was a year ago. Pepkor has a banking license. Raynet is flush with cash. Afrimat's core aggregates business is growing strongly, and WeBuyCars is expanding its footprint through a cyclical dip. These are companies being tested by the market, and they are passing. Yes, the rate hike is uncomfortable, but it is not a crisis. The SARB is doing its job, and with Eskom stable and GDP growing, slowly but growing, the medium-term backdrop for SA equities remains, in our view, constructive.